Joining me now to talk more about the market, the economy, where we head from here, especially as this Fed meeting starts, is Gregory Faranello. He's head of U.S. rates at AmeriVet Securities. Greg, welcome.
Kristen, thanks for having me.
It's great to have you on the show, and no shortage of things for us to discuss.
For sure.
Certainly in this market right now. So the S&P 500 down about 8% from its record high. How do you see the market right now?
So I think the market in general is in transition, if you will. What we try and do is we try and go back and find some context, right? Other pockets of time. This is certainly a pocket of time, no question about it. Being driven more so from the fiscal side, which I think is a little unusual for investors. But look, if you go back to 2008, we had the global financial crisis. 2015 and 16, we had the liftoff with Chair Yellen. We had issues with China. 2018, Chair Powell tried to tighten. 2020, we had the pandemic.
Yeah.
In 23, we had the regional bank hiccup. Last year,
Right.
we had a little bit of a yen carry trade unwind. So this is a pocket of time. Certainly, I think when we look at the charts here, we're not ruling out further downside risk.
Yes. And I think that would match, of course, what we've heard from President Donald Trump as well as Treasury Secretary Scott Bessent, not ruling out a recession, either of them, and saying that, as you mentioned, a period of transition and detox. We're going to hear from the Fed Chair Jerome Powell tomorrow. How does he address this?
Well, probably carefully, when it comes down to the fiscal side. It's the market is going to want a lot, and certainly I think a couple of components to tomorrow's meeting. One of which is, we do think that the Fed will acknowledge the economy has slowed down. If you look at the survey data, the hard data has held up fairly well. If you look at the survey data, clearly consumers are concerned here. Corporations are also concerned as well. So I do think they will acknowledge that. We do get another summary of economic projections. It's likely they downgrade GDP a little bit, which is what we're expecting. They probably up the inflation forecast a little bit, right?
Yeah.
So we're still a little sticky. And then, my sense is probably 2, maybe 3 rate cuts penciled in for 2025. And then a slow pathway in the next couple of years back down to more neutral levels, call it, 3.25%.
Yeah. What more, Greg, can you tell us about the expectation of slowing growth and perhaps higher inflation expectations?
Not a good combination, right? We talk about stagflation. We are personally of the opinion that if growth does slow, which it appears it is slowing, over time inflation will probably come down as well. So we're not in the stagflation camp, but if you look at the data right in front of us right now, it does look like we are in a sort of stagflation-like pocket of time.
We talk a lot about the economic cycle, right, and how the equity market, obviously, as trade is underway behind us, performs during an economic cycle. Does this indicate to you that we might be at the end of this economic cycle?
Not necessarily, right? I think we're seeing a dramatic shift on the fiscal side of the equation. Clearly, if we're going to pull back on spending, you would expect growth to slow. But I also think there are other things coming out of this administration, whether it's regulatory, whether it's energy policy over time, where at some point, growth will pick up back again. I think the administration is being very reflective of the fact that this could be a painful pocket of time. We don't know how long that pain is going to be. But the job market seems okay. We're going to transition from public sector jobs to private sector, and there may be some pain there. But longer term, we're still constructive on this economy.
Should investors be concerned about the recent volatility? It was a pretty dramatic sell-off. The S&P sold off for 4 straight weeks. We did enter a correction down 10%. We saw some dip buying the past 2 days or so. How should investors respond to that?
Yeah, look, that's a good question. We field phone calls all the time from people that we know. What's going on? Why is it going on? And look, volatility is a part of markets. You and I know that. We've been doing this for a long period of time. Markets go up, they do come down. This is very volatile. It's a little difficult to understand because we don't know exactly how all of these changes are going to unfold with regard to what's coming out of DC. But look, I mean, these are opportunities too, right? I mean, and we're not sitting here calling a bottom to the market.
Yes.
But if you're a long-term investor, which I am, and I know a lot of people are, you look for opportunities like this to scale in, right? You don't put all your eggs in one basket. You diversify. You look for opportunities. AI is not going away, but certainly there's a rethink there. And I do think there will be opportunities along the way. You just need to be careful how you allocate. And like I said, I mean, you don't want to dive in all at one time. But if you have capital on the sidelines here, I think these are good pockets of opportunity.
Very quickly, Greg, obviously it sounds like you do see rates coming down, though, based on what we've seen.
Over time, I do. I mean, we added some duration to start the year. You know, 10-year yields in particular. I know Treasury Secretary Besson is focused. They're focused on the 10-year yield. We focus a lot on that part of the curve. 470, 475, 480. We added some duration, and we do like the lower rate story over time. We're consolidating a little bit higher here. But if we move back toward that 450, 470 level, we would certainly look to add duration in Treasuries and in credit.
Greg Faranello, he's head of U.S. rates at AmeriVet Securities. Greg, thank you so much.
Thank you, Kristen.
It's great to have you.